Financial markets today look calm, almost too calm. Stocks are rising, bond deals are low, and investors seem confident. But beneath the surface, something is building. Some of the most powerful financial leaders in the world are sounding the alarm. But even they admit they won't know when the exact moment the next crash will hit. A lot of assets, warned Jamie Dimon in mid-October, look like they're entering bubble territory. His voice carries because he runs America's biggest bank, JP Morgan Chase, but also because it's part of a growing chorus. David Solomon, Mr. Dimon's opposite number at Goldman Sachs, talks of investor exuberance. Jane Fraser, Citigroup's boss, of valuation frothiness. The Bank of England recently cautioned that the risk of the sharp market correction has increased. The IMF worries about a disorderly one since risk asset prices are well above fundamentals. But here's the twist. Even though the smartest people on Wall Street know something's wrong, none of them can tell you when the crash will happen. Let's start with what everyone agrees on. Markets are expensive. Stock valuations are near historic highs. To buy the S&P 500 today, investors are paying 40 times the average earnings of the companies in the index, a level only seen during the dot-com bubble. Meanwhile, investment-grade corporate bonds are yielding just 0.8% more than government bonds, something that last happened in 2005, right before the global financial crisis. Even gold, the traditional safety asset, is showing erratic behavior. It recently hit a record high and then fell nearly 9% within days. Something's clearly off. This is the first sign of trouble, but this is not the reason the crash will surprise everyone. To understand why nobody can time the next crash, we need to understand volatility. Volatility is just a measure of how much prices move day to day. Right now, volatility is low, meaning prices are moving slowly and steadily upward. But volatility is not constant. It works in regimes. There are two phases. Low volatility periods where markets are calm, predictable, steady. And there are high volatility periods where markets are chaotic and prices swing violently. The crash happens when the market suddenly switches from the low volatility period to the high volatility period. The problem is, no one knows when that switch will happen. Volatility is bimodal, meaning prices spend long periods moving by relatively small amounts each day, interspersed with much shorter ones during which they move a lot. Volatility, in other words, is a tendency to junk itself. There are low vol regimes and high vol regimes, with not much in between. These regimes are correlated with the broad direction asset prices are moving in. During low vol periods, prices tend to be stable or rising. During high vol periods, they tend to fall. This is why the crash always feels sudden, because in reality, the market doesn't slide into danger, it snaps. Most trading models used by hedge funds, banks, and risk teams are built to predict tomorrow based on today. If markets are calm today, the models assume they'll be calm tomorrow. This approach works until it doesn't. The fact that volatility mostly stays in one regime or another means that most of the time, the best way to predict tomorrow's vol is from today's. This is the basis of the autoregression models used by traders at banks and investment firms to gauge risk. Such models are also used to price options, contracts that allow traders to profit from big swings in prices, since this requires an estimate of expected volatility. Yet, though useful from day to day, these models are ill-equipped to predict the sudden vol jumps that accompany corrections when the regime changes. In simple terms, everyone's risk models break at the exact moment they're needed most. That's why financial crises always seem unexpected, even though the warning signs were clear. You might think that advanced data systems used by firms like Bridgewater would be able to detect the warning signals. They do try. They analyze things like GDP growth, corporate earnings, employment trends, inflation data, consumer spending. But even the best macroeconomic models can't predict shock events. Macro models can pinpoint situations in which one might have an outsized impact on markets, yet not when it will occur. And even the best of them cannot predict pure shock like a pandemic or a run on a bank. The very unpredictability of such shocks means they have the greatest potential to trigger a correction. The moment that triggers the crash will feel random. It may be a failed corporate debt rollover, a surprise bankruptcy, a diplomatic crisis, a cyber attack. It doesn't matter. The point is, it won't be something Wall Street's models can see in advance. So how do traders react when the crash starts? Not by predicting, but by responding quickly. When prices suddenly fall, traders look for confirmation signals like multiple assets falling at once. Since volatility tends to jump at times when price change direction, momentum traders often dump their positions immediately after the first big move, down snaps a winning streak. Correlations between different asset classes also sometimes provide an early warning that a correction is afoot. The classic sign that investors have switched to risk-off mode, for instance, is that share prices fall at the same time as those of havens such as gold and treasuries rise. The most recent major market crash took place in March 2020 at the onset of the COVID-19 pandemic. What makes this crash important to understand is not just the speed at which it happened, but how it moved from the financial markets into the real economy. At the start of 2020, global stock markets were at record highs. Business confidence was strong and employment rates were low. On the surface, the economy appeared stable. Yet, as news of the virus spread internationally and governments began announcing restrictions and lockdown, confidence began to weaken. Markets are highly sensitive to uncertainty, and in situations where the future becomes difficult to predict, investors typically move quickly. Between late February and late March 2020, the S&P 500 fell by around 34%. This was one of the fastest declines on record. Companies across many sectors, especially airlines, hospitality, and retail, saw their share prices fall sharply. But the decline was not limited to a few industries. Almost every major asset class moved downwards at the same time. The issue was not simply reduced earnings or temporary disruptions. It was a sudden and widespread reassessment of risk across the entire global financial system. Investors were no longer trading based on performance. They were trading based on fear. However, the market crash was only the first stage. The recession that followed took longer to become visible. When financial markets fall, the effects do not immediately show up in everyday life. People still go to work, businesses still operate, and the economy continues to function. The confidence shifts. Households become cautious about spending. Businesses slow down hiring or pause investment plans. These adjustments take time to filter through the system, but once they begin, they create a chain reaction. This is exactly what occurred in the month after the crash. As restrictions continued, businesses experienced a sustained drop in revenue. With less income and ongoing costs, companies were forced to reduce expenditure. The first signs were hiring freezes and investment delays. The next stage was more visible: layoffs. In April 2020, US unemployment rose to 14.7%, the highest level recorded in modern times. Millions of people lost jobs within a single quarter. The recession had moved from financial markets into households and workplaces. At the same time, governments and central banks intervened. The Federal Reserve cut interest rates to near zero. Trillions of dollars of financial support and stimulus was introduced. Emergency loan programs were created. These actions stabilized financial markets relatively quickly, and asset prices began to recover faster than the broader economy. In fact, the stock market started rising again while unemployment was still historically high. This is a key point. Markets and the real economy do not always move together. Markets respond to expectations, liquidity, and confidence. The real economy responds to income, employment, and production. This led to an important outcome. The recovery did not benefit everyone equally. Those already held investments saw their portfolios recover. Those who had savings were able to buy assets at discounted prices. Meanwhile, many households experiencing job losses or reduced income unable to take advantage of the recovery. The result was a widening of the financial gap between those with capital and those without. The crash did not erase wealth, it reallocated it. Understanding the 2020 crash is significant because it provides a clear example of how quickly conditions can change and how markets can move before the real economy does. It also shows that by the time a recession becomes visible to the public, the adjustment is already underway. Market crashes are sudden, sessions unfold slowly, and confidence is often the first thing to shift. In summary, the conditions for a market correction are building long before anyone can point to the moment it begins. Prices look stable until they don't. Risk appears manageable until it suddenly isn't. And the very systems designed to measure and control volatility are least effective when the shift actually occurs. This is why even the most experienced figures in global finance acknowledge the limits of prediction. Wall Street will not miss the next crash because the signals were absent, but because the change will happen faster than the models, the forecasts, and the assumptions can adjust.